I'm Ian Castle, founder of Microcap Club, home to the best microcap stock pickers on the planet. Since 2011, our members have profiled over 1,300 microcap companies, with over 290 turning into multi-baggers. That's more than one big winner every single month for 14 years. If you share the passion for finding great companies early, before Wall Street and the institutions, Microcap Club is where you belong. Join us. Okay. Before we get started, I want to remind all participants the purpose of this presentation is for informational and educational purposes only and should not be construed as a recommendation to purchase or sell any security. Microcap Club is not a registered investment advisor. Microcap Club, its partners, members, subscribers, Ryan Telford, affiliates, may or may not hold positions in one or more of the securities mentioned on this program and may trade in such securities at any time. Do your own due diligence and seek counsel from a registered investment advisor before trading any security. Well, I want to thank all of you for tuning into this live presentation with Ryan Telford. I'm sure many of you follow Ryan on X. He's also the head of evidence-based research on Microcap Club. And if you're part of the community, you can find over 30 evidence-based pieces that he's written on a variety of unique and interesting topics. And, Ryan was supposed to give this presentation in Toronto in October, but he was under the weather. So we thought, we'd give it another shot and set it up as a live presentation for everybody today. Before I hand things off to Ryan, I want to remind people if they have a question during the presentation, you just have to click the Q&A button at the bottom of your Zoom screen and you can enter them there, and we'll get to those questions after Ryan finishes his presentation. So Ryan, the floor is yours.
Perfect. Thanks, Ian. Thanks everyone for calling in. Yeah, as Ian said, unfortunately I couldn't make it to the conference for unforeseen circumstances. So I was going to present there, but Ian's provided this opportunity so I can talk here today. So let's get into it. Uncovering the edge in Canadian microcaps. Excuse me. So if you'd invested in the Canadian TSX index 10 years ago, you would have doubled your money. Not too bad. But you also would have underperformed all US major indices by a wide margin. The S&P 500 has tripled, the NASDAQ has 5x'd over that same time period. So from these results, it looked like Canada has been underperforming market in the last decade. And following the common narrative, how can a market made up of commodities and big banks outperform US tech? But let's not jump to conclusions too quickly. These are large caps. Let's take a closer look at the other end of the spectrum to our beloved microcaps. We'll see a very different picture. As opposed to their large cap cousins, Canadian microcaps have actually outperformed US microcaps for the last 10 years, both broadly and when broken down by different levels of quality. When we add in a few factors such as growth, value, timing, and sentiment, as we have in the MC Guts Microcap Index, Canadian microcaps have outperformed by a wider margin. In fact, the underlying strategy to this microcap index has 10x'd in the last 10 years, while the US version has only 5x, which I must say is quite still respectable, especially compared to the IWC, iShares Microcap Index, which is about doubled. And this is a cut sheet that we've developed for the strategy, which is available on Microcap Club. And this performance in Canadian microcaps hasn't been limited to just a few good years. Looking back, we do see consistency, where Canada has outperformed US MC Guts in about 6 of the last 10 years. And just for fun, speaking of the last year, if you invested equally in all the Canadian stocks that were presenting at the conference last month, 1 year ago, you would have made more than 80% on your investment. Not too bad. So despite broader underperformance of Canadian indices and large caps, Canadian microcaps have been quietly outperforming, which is quite Canadian, I must say. So what is it that's unique about Canadian microcaps? There must be some sort of edge that they've had over the last decade. So while it's true that Canadian microcaps have similar similarities to US microcaps. They also have notable differences to their cousins. Let's take a look. But before we get into the Canadian edge, all data and some charts in this presentation have been provided by Portfolio 123. I use Portfolio 123 for all of my quantitative strategies and research. Feel free to give it a shot. See if you can complement your own investing with it. And just a disclaimer, all backtesting and simulated performance here is no guarantee of future results, and there are no buy recommendations in this presentation. Okay, so firstly, what is a microcap? There seems to be different definitions. Different people can call them different things. But for this purpose, we're looking at 300 million market cap or less in their respective currency with some sort of minimum liquidity. I define that as 10 cents a share or $10,000 of daily volume. And even within microcaps, we have got subcategories. Anything less than 50 million is considered a nano cap, and below 10 million, a pico cap. I use a universe of stocks called MC Guts, the same used in the MC Guts market cap index, which is primary listed stocks, so no OTC, excludes financials and utilities. Most of the upcoming charts and graphs are based on these universes, unless noted otherwise. To get an idea of how large the market cap pond is, broadly speaking, across Canada, US, and Europe, roughly 30% of all liquid stocks are microcaps. And as you may suspect, Canada being a resource economy, the majority of Canadian microcaps are mining and energy, about 2/3, with smaller proportions to industrials, tech, and consumers cyclicals. If compared to US microcaps, predominantly healthcare and financials, with a small proportion mining and energy. Many investors avoid mining, commodity, and cyclicals altogether. So this high concentration in Canadian microcaps may provide some sort of a stigma to Canadian microcaps, but an opportunity for others. What makes microcaps unique from large caps, regardless of geography, is the variety of quality. Many microcaps don't even have revenue, and if they do, they may not be profitable. For perspective, large caps, it's a given that all stocks have sales, and the majority are profitable. And the distribution of these stocks varies between Canadian and US microcaps. Compared to US and Europe, Canadian microcaps have the smallest proportion of stocks with sales, only 43%. And again, for context, 100% of stocks in the S&P 500 have sales. When it comes to profitability, only 18% of Canadian microcaps are in the green, and US microcaps slightly higher with 24% versus 94% of profitable stocks in the S&P 500. So getting back to market cap, there is another key distinction between Canadian and US microcaps. US microcaps are shrinking. Over the past decade, the median market cap of US microcaps has steadily declined. The orange curve, from about 100 million 10 years ago to around 50 million today. In contrast, Canadian liquid marketcaps have stayed relatively stable, ranging between 50 to 75 million in the same period. That's the blue line. So while both markets have similar median sizes today, the trend is different. US market caps are shrinking. But for what reason? A key reason is sales. As we discussed earlier, not all market caps have revenue, but those that do, US market caps have seen a drop in median sales from around 100 million a decade ago to about 30 million today, with some volatility. Canadian market caps have had some ups and downs, but have remained more stable, with median sales hovering between 20 and 50 million, and currently around 50. So on a median basis, Canadian market caps now generate more revenue than their US counterparts. But market cap and sales are related by the sales multiple. Price of sales varies over time for our microcaps, but on average, the market has assigned Canadian microcaps sales multiple of roughly 1.5 to 2 versus 1 to 1.5 for US microcaps. And again, for comparison, the price to sales ratio for large caps has typically been about 2 to 3, which is the dotted line. The discussion on microcaps wouldn't be complete without talking about liquidity. Illiquid is usually a term applied to Canadian microcaps, especially those in the TSX Venture Exchange. Illiquid meaning that you cannot easily buy or sell these stocks. But it's important to keep in mind that liquidity can vary per stock, can vary at certain time periods, and is very specific to each investor. How much capital they have to invest, how much per position, et cetera, and how patient they are to get filled on buys and sells. And how do US and Canadian microcaps vary in their liquidity? Well, first, for perspective, on the left-hand column, as of today, US large caps in US S&P 500 trade roughly $150 million per day. But as you can see from the graph here, US and Canadian microcaps don't even register at this scale. US microcaps, as of today, about 200,000 per day, or about 0.1% the volume of large caps. And Canadian microcaps even less, about 50,000. But like many things in finance, liquidity is not normally distributed. We can have stocks with much higher and much lower liquidity than these median values. But perhaps this illiquidity is the edge for Canadian microcap retail investors. Liquidity prevents largest institutions from entering and allows one to get in before the institutions and their stock moving capital. But more on this shortly. Another adjective for microcaps, underfollowed. Can mean different things, but let's look at two interpretations here. Low analyst coverage and low institutional ownership. Analysts who cover stocks will provide estimate for forward sales, earnings, and other key factors. For large stocks, this is kind of a given. For perspective, nearly all stocks in the S&P have coverage by analysts. However, the smaller the stock, typically the less coverage. And these forward estimates often set expectations for how the stock is expected to perform in the future. Typically, the more analysts, the more robust the consensus, the fewer the analysts and data points, a weaker consensus can be actually a good thing for a savvy investor. Today, just over 30% of Canadian microcaps have analyst coverage versus 48% coverage in the US microcaps. And those that do have coverage have fewer analysts. We have a median of 1 analyst per microcap in Canada and 2 in the US versus 19 for S&P 500 stocks. And these numbers have actually been dropping over time. There are far fewer microcaps being covered by analysts than there were 10 years ago in both Canada and the US. The number has been dropping faster in Canada, the orange line. And when it comes to institutions, such as funds and family offices, while the majority of both US and Canadian microcaps have some level of institutional ownership, 85% in Canada, 95% in the US, institutional ownership per stock is lower for microcaps. Where the S&P median institutional ownership is 82%, it's much lower for microcaps. US microcaps have a median of 18% institutional ownership, and you guessed it, even lower for Canada, about 7%. And like analyst coverage, the median percent ownership for microcaps by institutions has also been dropping over time. By about half since 10 years ago, and still lower for Canada. So Canadian microcaps have fewer stocks covered by analysts, fewer analysts per stock, therefore a weaker consensus, fewer expectations, fewer institutions invested, which could reasonably be called underfollowed. maybe even inefficient, and quite possibly opportunity. After investing for microcaps for some time using quantitative strategies, found that the most successful ones share a few common factors. The underlying details can vary between strategies, but they tend to be similar in philosophy. Call this the GUTS methodology. G for growth, U for undervalued, E for timing, and S for sentiment. This is a simple framework I've devised for my own investing, and I've incorporated it into the MC GUTS index at Microcap Club. We'll look through the lens of GUTS for these next few microcap character traits. Earnings growth is one of the most significant drivers of stock returns over time. We'll look at the two underlying components of earnings, namely sales growth, and margins. Taking those microcaps with 10 years of revenue, median revenue growth of Canadian microcaps has been several times that of US microcaps across various sectors. Annualized 2% for US microcaps, 8% for Canadian. Now, keeping in mind forever, the first characteristic that we just talked about is that there are a smaller pool of Canadian microcaps. Microcaps with sales is quite different. There are 1,800 stocks in the US with sales and 200 in Canada. Still, as we can see, this is not being driven by a single factor, as each Canadian sector has outgrown the respective US sector other than consumer services. Cyclicality can also play into sales growth. Cyclical is one of those terms that's often used in finance, but as far as I know, it does not have a concrete definition, or at least one that I've been able to find. So I've created a quantitative score I call the cycle score. It's the ratio of positive cycle time to negative cycle time in sales growth for a stock over a given period. And sales growth is one of the cleanest and less noisy values out there. So it tends to be a good candidate for measuring cyclicality. The stock is scored from +1 to -1 and on a spectrum. So a score of 1 being all secular growth, which is not a cyclical at all. These stocks are quite few and far between, quite rare. Amazon being an example. Score from 0 to 1 is a positive cyclical, spending more time in its cycle in positive growth territory than negative. Higher the number, less cyclical. And 0 to -1 is a negative cyclical, having more negative growth in its cycle than positive. So in the interest of time, I'll spare further details here, but I'll share a more detailed post on cyclicality at Microcap Club in the near future. So while many microcaps are naturally cyclical, Canadian microcaps have been less cyclical over the last 10 years when measured by the cycle score. This may come as a bit of a surprise, as Canadian microcaps are associated with highly cyclical commodity sector stocks. So what reasons could there be for such higher growth rates? Remember, the Canadian microcap space is still quite small. 500 Canadian microcaps versus 2,000 US. Maybe there's less competition. Is there more room for Canadian microcaps to grow? There could be more factors at play here, but the data is clear. The other component of margin of earnings is margins. When it comes to gross margins, US microcaps in orange have managed to maintain higher margins than Canadian microcaps in the blue. At times by a significant spread, especially around COVID, where there's about a 10% spread, 10-point spread. But interestingly, we see a different trend when we move on to net margins, or the margin basis for EPS, where Canadian microcaps have taken the lead in blue nearly consistently, and highest spread during 2022 during the energy boom and the unfortunate Ukraine crisis. Taking a snapshot today, median margins or net income of Canadian microcaps are about 25% higher than US microcaps, 8% versus 6%. So the combination of strong sales growth and margins has shown a meaningful earnings trend in Canadian microcaps. When it comes to value, are Canadian microcaps cheaper than US microcaps? As we saw earlier, historically, Canadian microcaps have enjoyed higher price to sales valuations. But when it comes to earnings multiples, there is another difference, but more nuanced. In the most recent 5 years, profitable US microcaps have had a higher PE ratio than Canadian microcaps, orange curve. And in the 5 years previous, they're more or less the same. That said, US or Canadian cheap stocks, or buying the stocks with the cheapest PE multiples or other earnings multiples, have had similar returns in the past few years. But only buying cheap stocks doesn't really tell you much. Some stocks and sectors have perpetually low valuations and do not change much over time. So there's little re-rate to profit from. Sometimes buying cheap only, you get what you pay for. But there is a difference between finding cheap and finding value. Cheap implies just a low price, but value suggests you're trying to find best bang for your buck. And these are different. Sometimes get missed in the value conversation. Don't take it from me, though. As the Oracle Warren Buffett has said, value and growth are part of the same equation. And unsurprisingly, the data does support this. And Peter Lynch went so far as to give a name, the peg factor. Now, if you look at value with growth, there is a more notable difference between US and Canadian microcaps. Here's a simple ranking system in portfolio 1, 2, 3 I call Pegasus, which ranks all stocks on low earnings multiples, but the first group, but also on high growth, the second group, both past and future, if there's data available from the analysts. Now, if we rank all US microcaps using Pegasus and take the top 5% with a monthly rebalance, the strategy in the US has nearly 6x'd in 10 years. Not too bad. But doing the same in Canada, strategy has nearly 12x in the same period. Does value matter? Yes, in isolation. But not in isolation. But we're sure we need to be sure that we're getting something too. And in Canadian microcaps, there's certainly been bang for the buck. Timing, the tea and guts. Timing is a hot topic. You can't time the market, as we're always told. But at the same time, every buy and sell decision has some sort of element of timing to it. Timing can be price momentum, technicals, and other price-related information. A great illustration is 52-week highs and lows. If a stock is reaching 52-week highs, it's gaining in price. 52-week lows, stock's becoming lower in price. In the intuition of many, including myself some time ago, was that 52-week lows are a buy signal. Cheap. The stock is cheap, right? But according to the data, buying stocks near the 52-week highs has been more bullish. What about Canada versus US microcaps? Taking the top 10% of stocks closest to the 52-week highs, Canadian microcaps have outperformed. On a CAGR basis, 23% for Canada, about 10% for the US over the last 10 years. And the spread widens with higher quality microcaps, those with sales and those that are profitable. So overall, in these same groups, Canadian microcaps still near the 52-week highs have outperformed US microcaps. Again, keeping in mind that there are fewer stocks in Canada compared to the US in the microcap space. So timing matters, regardless of market, but when you include factors like momentum, 52-week highs in this case, returns tend to be higher for Canadian microcaps. And finally, the S in guts, sentiment. But what is sentiment exactly? I define it as the behavior of other market stakeholders, analysts, shorts, institutional investors. Some may call this the smart money, like we saw with how microcaps tend to be underfollowed. One analyst related factor is earnings beats or misses. What is being beat or missed is the expectation of earnings, consensus forward earnings, or sales estimates provided by analysts. And a beat or miss can have a significant impact on a stock's price. The conventional wisdom being that an earnings beat should result in a price gain and a drop in price in an earnings miss. Let's check in with the data. Once again, for perspective, portfolio of S&P 500 stocks that have only beaten estimates have performed more or less the same as the S&P 500 itself. This is the first column, as there's no benefit to earnings beats as a group. But earnings misses have impacted returns. Perhaps the expectation here is that S&P 500 will actually beat earnings. In US microcaps, the middle column, we actually see negative performance for microcaps beating estimates in the last 10 years as a group. In Canadian microcaps, for those that have beaten estimates, they've actually outperformed US microcaps beating estimates and Canadian microcaps overall. But there has been a downside where Canadian microcaps have missed estimates. They've underperformed US microcaps that have also missed estimates. So recall from earlier, the Canadian microcaps on average have less analyst coverage and less analysts per stock. So could we say that the higher the coverage, the more firmly set the expectations for a stock? Perhaps. To conclude here, Canadian microcaps are few, resource-heavy, illiquid, underfollowed, with some key strength and fundamentals compared to US microcaps over the last 10 years, and have tended to outperform on some key factors. We've looked at some similarities and differences between US and Canadian microcaps, and I think we can say that while they may look similar on the surface, they behave quite differently, both fundamentally and in terms of returns. Now, we have been looking at microcaps broadly. There are certainly outliers in each group, both positively and negatively, and should not suggest that these properties apply to every microcap. Investing is about the future. Whether these differences will help Canadian microcaps to continue to outperform is anyone's guess. At the very least, we have several data points that we can refer to, see how they change over time, and potentially impact performance in the future. If you found this presentation helpful, check out the evidence-based forum at Microcap Club. Since starting in February of this year, we've got 30 research pieces on microcaps covering US, Canada, and Europe. And also be sure to check out the MC Guts index of 240 microcaps from US, Canada, and Europe, based on some of the guts factors discussed today. Well, thank you for your time. And yeah, we can open up to any questions.
Yeah, if anybody has any questions, feel free to type them into the Q&A button. You know, it's a very robust presentation. Thanks, Ryan. Appreciate that.
Thank you.
I thought one of the interesting things that you highlighted was the Canadian companies that are within 10% of hitting a 52-week high. You know how they kind of fast. Now, I think the sample size was 12 companies, if I remember. But you know, it seemed like that was a much larger factor than the US microcaps. And I guess that would just be a way of saying that momentum is more important, would you say, in Canadian microcaps?
Yeah, I think that's fair to say. I mean, momentum is a powerful factor, but there's something about Canadian microcaps that makes it quite a bit more robust. And I mean, there's different ways. I mean, that was just one example. I mean, you can look at simple price momentum, industry home momentum as well is a good one.
Looks like we have a question that came in. How does liquidity affect performance? If you increase your liquidity threshold to $25,000 per day, for example, what's the impact on returns?
Yeah, so performance does alter a little bit. I mean, it's certainly not a step change, but the more liquid you go, performance does adjust. Um, I think being retail investors, microcaps, I mean, being able to stay in that zone below definitely helps. But I mean, we've done other tests where we increase the liquidity. And I mean, I'm trying to think of an example. Don't quote me on this, but I mean, like a sample that would return, or a group that returns, say, 15% annually might reduce to say like 13% annually. Don't quote me on that, but I mean, that's sort of the order of magnitude adjustment.
Okay. Any other questions? Give another 30 seconds. It would be interesting, Ryan, if you also kind of looked at the European swath of companies too, and how that compares. Did you do that while you're doing the US and Canada?
Not for each factor, but some of these factors I've done some of the previous comparisons. Actually, some of the posts at the evidence-based compare all three.
Mm-hmm.
This emphasis here was kind of to stay within the Canadian theme of the conference in Toronto.
Right.
But yeah, no, it would be fun to do the same for Europe. I mean, just from some of the work that we've done so far, European microcaps are definitely an interesting group. For some of these factors, they do outperform both US and Canada, and others maybe not so much. But maybe when we have our conference in Europe, Ian, then I'll do one then.
Yeah, there you go. Well, thanks, Ryan. Appreciate you running through this presentation and appreciate everybody for tuning in. Thank you. Have a great weekend.
Perfect. Thanks, everyone.